Okay, good evening, guys, and then welcome to another 123 Forex session. For a while now, we've not had any sessions. I think we had a session early this year, that was in January, but then for a while now, we've not had any proper session. Do you understand? So today, I know the group has been calm, it has been pretty quiet. So today, I really want us to do something. Let's see how we can better ourselves in the Forex market. Do you understand? For a while now, even I've been, how will I put it, I've been learning a lot of things in the market, and then it's more or less me trying to share this with you guys and then see how you guys too can actually get better in the market, because a lot of us are still struggling with more or less identifying trades, knowing how to manage our emotions in the market, all that. Do you understand? So what we're going to do today is more or less try to augment all these things. Do you understand? Where can we get solutions, or how can we get solutions, or what solutions could we use? Do you understand? Those are the things we are going to be looking at today. Can you all hear me clearly? Please, you guys should confirm my audio so I know you guys are hearing me clearly.
Yes, I can hear you. Kobe.
Okay, okay. Okay, good evening, everyone. Those that are just joining, good evening again. So, so what we're going to do today, like I said, we're more or less, we'll do technicals, but I really don't want us to do technicals much. So we'll do technicals, and then at the same time, we'll still do more of trading psychology. Do you understand? I know a lot of people, a lot of you guys still have not developed strategies. But then once you've learned how to develop strategies, or once you've gotten a strategy, the work stops being on the chart and then it becomes in your head. What work are you doing to be better? What work are you doing to be much more emotionally stable? Do you understand? That's what you're supposed to be looking into. You get, and that's what we're going to be looking at now. Hope you guys are following.
Yes, we are.
Okay, good. So, anyways, what we're going to be doing here, this is how we're going to do this class today. First of all, well, how many are we here? We're seven at the moment. Kiddo is joining. So yeah, we're still seven. You guys are seven plus me, eight. So you guys are gonna be asking questions. I think would start with, see, okay, here I have the P. It has been long since I've been on a live session with you guys. I remember this the P guy. Yeah, who's Victor? So now I think the P can start, Alfred can start. Whatever problems you're having or whatever you want me to solve, just ask, and then we'll basically do it. If it's chat work, we'll go to trading and then do it. If it's more or less trading psychology, I offer advice. I think that's what we're going to do today. Hope you guys are cool with that. So who wants I said DP can go first. You can start. If you have any issues you're facing, you can ask. Or do you guys want me to pick a topic and then talk about?
Yes, please.
Okay, you guys maybe answered. Okay, you guys want me to pick a topic and then talk
Good
about.
evening, sir.
Yeah, good evening, kid. How are you doing?
Fine, thank you, sir. How's work, sir?
Everything is fine. You are doing well.
Sir, I have this small problem with trading.
Okay,
I
what's
get everything fine, but then I use consume it. So anytime I trade with US 30, anytime I trade with you with US 30,
yeah,
they charge it is like $1 per people, 0.01.
really?
So after like 0.01 is like $1 per people.
Yeah,
So whenever I suffer with GBUSD and remaining currency pairs
yeah.
to get to the top, when I enter US 30, I end up losing like 3% or 2%.
Well, I
And
think
then anytime I'm trading that, it
yes.
makes me overtrade.
Okay.
That's your effective.
Okay. So now I think
Because the currency pairs are too slow for you to overtrade before you hit stop loss or take profit.
okay. So this is what I'm gonna say. Yeah. First of all, you've already identified the problem. It's coming from you trading US 30. So I think for now, if you're using you said it's consumer traders, if you're using them to trade, then don't trade US 30. Do you understand? You can leave US 30 for now. You can trade US 30
But
on
then I feel like
yes.
I feel like I don't know why I always feel like if I get one good trade with ESET, I can get like 3 or 4%. Or is it that I'm rushing to?
Okay. I get where you're coming from. And I think this is one thing
The
that
problem is from his spread.
no one sec, yeah, I want to say something. Um
Okay.
there's this Navole story, guys, that even if I give you a short trade, if in short, if God Himself comes to tell you that you see this trade is going to work, do you understand? It's a short trade that is going to work. It must work. If you have that assurance, you can never make all the money in the world with it. Do you understand? Forex is something that's how will I put it? Slow and steady is actually faster than fast and then risky. I don't know if you guys understand. So if and I even wanted to talk about this earlier, that patience in trading is not just coming from you holding trades till they hit take profit. Do you understand? Or till they hit like times 10 of what you risk. Trading, patience in trading also comes from you growing that account gradually. Do you understand? Keeping a cool head after making a couple of trades. Let's say you've taken 10 trades and then you're only 10%, sorry, only 5% up. Do you understand? Keeping cool and then not over leveraging or not getting overconfident to is one way of being patient. Do you understand? So
Because I was
what you
expecting
could do
one.
is just stop trading USD and then focus on trading currency pairs. Since currency pairs are giving you money, stick to it. Do you understand? Currency pairs are much more safer. You can decide to fund $100 on your live account and then do whatever you want to do with US 30. Do you get? But then when it comes to
Okay.
challenges, please just stick to trading properly. I think that's what I'm going to say.
Okay, sir. Okay, sir. Thank you so much, sir. I really appreciate it.
You're welcome. So now, as I was saying, yeah, someone said I should pick a topic and then talk about it. So I think what I'm going to talk about, ah, let's see, what can I talk about? We've we've already done. Okay, let's go over market structure because I think this one is more or less like one thing a lot of traders actually get wrong. So we'll go over market structure. We'll talk about market structure. So let me.
Sir, please, can we go over it with support and resistance strategy?
Okay, so for half time we'll do that because the session would only last for I think 30 minutes. It's Zoom I'm using, so let's see. Let's see
Okay,
how it goes.
okay, sir.
If we still have anything left, I might do a class this week. That's by tomorrow or next week. So it depends on how my schedule is. I've been having a lot of classes lately. So now, market structure. What is market structure? Market structure, by definition, is just the movement of the market. Do you understand? Let me write down the movement of the market. Movement of the market. The movement of the market. Do you understand? Market structure, bottom line is just the movement of the market. Do you get? Now, if you guys, or if anyone, if you guys actually go over your introductory classes, yeah, one thing they always tell you is that you could either buy or sell in the market. And then if you're buying, price needs to go up before you make profit. And then if you're selling, price needs to go down before you make profit. But then there's still that possibility that you could decide to buy, and then price, instead of price going up, price decides to go down. Do you understand? It's very, very possible. And then you could decide to sell and then price just goes up instead of going down. It's still very, very possible. So the question becomes, how do I know when I'm supposed to buy? How do I know when I'm supposed to sell? Do you understand? That becomes one very important, how will I put it, factor that a lot of traders try to figure out. And then they tell you that, yeah, you can actually use this chart by looking at all these candlesticks, these red and green candlesticks. You could know that, oh, at this point, the market will most likely sell. At this point, the market will most likely buy. And honestly, if I walk up to anybody and then tell them that fact, that by looking at this screen here, by looking at these symbols here, you could know that at this point you should buy, at this point you should sell. The first thing the person might ask me is how? How do I know? Or the person might look at this chart now and be like, oh, at this point now, am I supposed to buy? At this point, am I supposed to sell? These are the questions that will pop up. Are you guys following?
No, like your voice stopped. Like you stopped speaking when you said the first question they'll ask you is, and stop hearing you. I don't know. From my side, I stopped, but I don't know for anyone.
Okay. I think it's for everybody. So now, as I was saying, yeah, the question becomes, how do you know when to buy? How do you know when to sell? Do you understand? And then they tell you that you can use your charts and then know. The person will be like, how? At this point now, where price is, should I buy? Should I sell? You hear a lot of questions like that from beginner traders. Do you understand? So now, the way or what you use to know that at this point you're supposed to buy or at this point you're supposed to sell is what market structure. Do you understand? market structure, the movement of the market. So it's from this movement of the market that you know that, okay, if the market is behaving like this, then I'm supposed to be looking to buy, or if the market is behaving like the other way, I'm supposed to be looking to sell. Do you understand? Now, when it comes to these movements of the market here, we have three of them. So we have one uptrend, which is also a bullish trend. We have downtrend, which is also a bearish trend. And then we have a ranging market. You could also call this a consolidation. Consolidation or consolidating markets. Do you understand? These are the three ways the market could move at any point in time. So if you come to the market, whenever it comes to the market is going to be doing one of these three movements. It's not going to be doing all at once. Do you understand? The most recent structure is going to be one of these three movements. Now, from that most recent structure that I know that, okay, at this point, you're supposed to be looking to buy. At this point, we're supposed to be looking to sell. So we're going to start with the first one, which is an uptrend. We're going to look at what an uptrend is. Do you understand? How to identify it? And then at what point does the market cease to be in an uptrend? Those are the things we are going to be looking at. So I'm going to write uptrend. Do you understand? Or a bullish trend. Now, an uptrend, just like the name sounds, yeah, it's a market that is going up. It's a market where price is going up overall. Do you understand? But then there's one thing you guys need to understand about the market. The market is never going to move in a straight line. Do you understand? The market is never going to move in a straight line. The market is always going to move in series of impulsive moves and retracements. So let me write that down. The market is always going to move in series of impulsive moves and retracements. Now, what are impulsive moves? Impulsive moves are more or less stronger moves in the direction of the trend. You get stronger moves in the direction of the trend. And then retracements on the other hand. Retracements on the other hand are weak short-term moves against the trend. Are you guys following? So now, no matter the direction the market is headed towards, the market is never going to move in a straight line. We're always going to have series of impulsive moves and retracements. So now, in this case, impulsive moves are stronger moves in the direction of the trend, and then retracements are weak short-term moves against the trend. So an uptrend now is a market that is going up. So I'm going to have series of impulsive moves and retracements. So now impulsive moves by definition are moves in the direction of the trend. The direction of this trend, the direction of this uptrend is what, to the upside. So I'm going to have what, a push to the upside. Now, retracements are weak short-term moves against the trend. So I'm going to have a weak move against the trend. Another impulsive retracement, impulsive retracement, like that. Do you understand? So now you can see that overall we're pushing up, but then it's more or less like I'm taking 2 steps forward, 1 step backward. Overall, you see that I'll be moving forward. Are you guys following?
Yes, sir.
Good. Now, this series of impulsive moves and retracement basically form series of higher highs and higher lows. Higher high. Higher highs and then higher lows. So, higher low. Higher low. Higher low. Higher low. Then we have higher high. Do you understand? So we have series of higher lows and higher highs. Are you guys paying attention?
Yes, sir.
Now,
Yes, sir.
a couple of things you guys need to understand about an uptrend is that first, like I said, it's a market that is going up. Do you understand? Now, another thing is this is a buy market. It's a market we're looking to buy. So anytime we're buying, we're expecting that price should go up before we make money. Do you understand? And then that's how the market works. So now if you look at this market, overall price is pushing up. So if I even walk up and then buy at a point where price is going down, if this market is going to continue being an uptrend, at some point I'm going to make profits. Do you understand? So buys are much more high probability in an uptrend. Are you guys following? So now, another thing you need to understand about an uptrend is that whenever I have a higher high, do you understand? Before I can have a new higher high, price needs to break above the last one. So price needs to break above the last one before I can have what? A new higher high. Are you guys paying attention? So now I can see that all the higher highs are breaking above the last ones. Do you get? So in a case where I don't break above the last higher high, it's not a higher high or it's not a new higher high. It's more or less maybe an equal high. Now, what confirms this break of structure or what confirms this break of the high is the close of a body of a candlestick above that level. So now in a case where it's just wicks of the candlestick that pass that level, it's not a break of structure or it's not a break of the previous high. What confirms the break of the previous high is the close of a body of a candlestick above the last high. Do you understand? Let me show you guys what I mean. So now, if you look at this high on gold here, if you look at this high, we had this high here. See this high here. Now, we had another high after that one. That's this high here. Now, if you look at this high here, this high actually broke above. See, if I draw a line here, you see that bodies of candlestick closed above that previous level. So there was a break to the upside. Now, this break to the upside basically created this higher high. Now, let me show you guys where price did not really break to the upside. One sec. I'm looking for a place where it's just wicks of candlesticks. Good. Now look at this high here. We had a high here, and then we had a second high here. Wicks of candlestick went up that level. So now, if I draw a line across here, you'd see that this wick here, if I extend this line to this side, you see that it was only the wick of this candlestick that broke above this level. In this case, now we don't have a proper break of structure to the upside. So now we can't call this a new higher high. I don't know if you guys get what I'm trying to explain. What confirms the form if a new higher high is that break to the upside. And now a body of a candlestick needs to almost close above that level before we can confirm that we'll have a new higher high. Are you guys following what I'm saying?
Yes, sir.
Yeah. So now, the next thing you need to understand about an uptrend is that whenever we're having an uptrend, always pay attention to the higher lows. So we're having an uptrend, higher highs, higher low, higher highs, higher low. So now always pay attention to the higher lows. So see all these levels here, these are higher low levels. Always pay attention to them. Why? Because first of all, that's where we're looking to buy from. Do you understand? Why are we looking to buy here? That's where the move to the upside starts. So whenever you have price creating a higher high, you wait for price to come back, create a higher low, then you buy to what? Ride that move to the upside. Are you guys understanding? That's where the move to the upside starts. So if I can catch this move as it's going up, I can basically what? Make profits. So the first thing is we're looking towards why we're looking to pay attention to these higher lows. First is what we're looking to buy from these levels. So whenever price creates a higher high, we have to wait for it to create a higher low, then we buy. Now, the second reason why we pay attention to the higher lows is because if at any point of price creating an uptrend, price comes back down to break a higher low to the downside. Now, if you look at this, you see that price was not breaking higher lows. All the higher lows were forming how will I put it now? We're forming above the last one. So in a case where price comes to break the last one to the downside, then that is a shift in market structure. Let me write that down. A shift in market structure. Now, what is this shift in market structure? This shift in market structure is just trying to, at this point now, this is no longer an uptrend. Because uptrend, the characteristics of an uptrend is more or less like higher lows should not break the previous one. So if at any point price breaks the previous one, then we have a shift. This shift is trying to tell you that this is no longer an uptrend. Stop looking for buys. Now, I did not say you should start selling. I said stop looking for buys. So anytime you see price break a higher low to the downside in an uptrend, just know that that uptrend is invalidated and you should stop looking for buys. Are you guys understanding what I'm saying?
Yes, sir.
Good.
Yes,
So
sir.
those are the things you need to pay attention to in an uptrend. Uptrend has series of higher highs and higher lows. We're paying attention to the higher lows, first of all, to buy. And then secondly, if price breaks a higher low to the downside, then the market is changing from an uptrend to what? Another trend. Now, I'd not say you should start selling because that's one thing a lot of guys get wrong. Now, a lot of guys feel like, oh, whenever price breaks a higher low to the downside, then it means I should start selling. No. Do you understand? Leave the market alone. Stop buying. Wait and see what structure the market will basically change to. Do you understand? So let's jump on our charts. Let's take a look at an uptrend. Let's find an uptrend and then map it out. Let me show you guys an example. So now if you look at this market here, yeah, you'd see that price created this high. Price pushed up, we created this high. Can you guys see where I'm drawing from? So price pushed up and then we created this high. We pushed back down and then we created this higher low. We pushed back up. Now this move to the upside here, did it actually break above the last high? Let me see. Now, if you look at this here, it was just the wicks of the candlestick that passed that level. So there was no break of structure to the upside. So I'm not going to call this a new higher high. I'm going to call it an equal high. Do you understand? After that, we pushed to the downside and then we had a higher low. We pushed back up and then we had this push to the upside. Now you can see that it clearly broke above this last one. So we had a new higher high, higher low, higher high, higher low, higher high. We sort of had a higher low here. Price pushed back up, we had a higher high. Now, price pushed back down and created this low. Now, if you look at that low, you see that price actually broke. Okay, it not really break below the last low because now look at the wicks of that candlestick there. Price not passes. So it was more or less like another higher low. Price went back up. We created a higher high, a higher low, and then another higher high. Are you guys following? So now you can see
Yes,
that
sir.
whenever price breaks structure to the upside, we have what? A higher high. Now, if it doesn't break structure to the upside, it's an equal high. Now, if you see that after this higher high, price pushed to the downside. And look at what we did. Price actually broke the last higher low to the downside, which actually meant that price actually started shifting structure to the downside. And if you see after that, price failed to go back up and then create a new higher high. Price was just bouncing in between. And after that, we started selling. We started what? Dropping to the downside. So whenever you see price break a higher low to the downside, whenever you see price break a higher low in an uptrend, that's a shift in market structure. Stop looking for buys. That's what it means. Do you guys understand?
Yes, sir.
Do you guys have any questions regarding this uptrend? Oh. So now the next trend we're going to look at is a downtrend. So now a downtrend now is basically a market that is pushing down. Do you understand? A downtrend is a market that is pushing down. A downtrend is a market that is going down. But then, like we've already established, price is not going to move down in a straight line. It's going to move in series of impulsive move and retracements. So now impulsive moves are moves in the direction of the trend. So now this trend is a downtrend. So price is what? Moving down. So now we have that push to the downside. Retracement is a short-term move against the trend. So we'll have that push back to the upside. Impulsive retracement, impulsive retracement, impulsive Do you understand? Now, this series of impulsive moves and retracements basically create series of lower lows and lower highs. So we have LL is lower low, LH is lower high. Series of lower lows and lower highs. Lower low, lower high. So Control C, Control V. So we have lower lows, lower lows, lower high, lower high. Now, the first thing you need to understand about a downtrend is that before I can have a new lower low, before I can say price has created a new lower low, price needs to break the previous one to the downside. Price needs to actually break the previous one to the downside before I can say I have what? A new lower low. Price needs to break the last one to the downside. Are you guys following? So before I can have a creation of a new lower low, price needs to break the last one to the downside. Now, another thing about a downtrend, and then, sorry, before I can say price has broken that lower low, body of candlestick needs to close below that level. Do you understand? That's what confirms the break of structures to the downside. Now, another thing we need to understand about a downtrend is that it's a sell market. We're looking to sell. Why? Because price is moving down overall. And whenever we're selling and price goes down, we're actually what's making money. So since this market has more opportunities to the downside, we're looking to sell. Are you guys following?
Yes, sir.
Now, another thing you guys need to pay attention to in a downtrend is that we're paying attention to the lower highs. Do you understand? We're paying attention to the lower highs. We're paying attention to the lower highs. Why? First of all, that's where we're looking to sell from. That's where we're looking to sell from. So whenever price breaks to the downside to create a lower low, we have to wait for price to go back up, create a lower high, then we mount ourselves and then basically ride the market to the downside. Do you guys understand? So now, whenever price creates a lower low, wait for price to go back up, lower high, then you sell to the downside because that's where the sells or that's where the move to the downside is what starting from. Now, another reason why we basically pay attention to the lower highs is because whenever we have a downtrend, and then instead of price going back up to create a new lower high and then sell to the downside, price goes back up and then breaks the last lower high to the upside. That's a shift in market structure. Now, what does this shift in the market structure in a downtrend mean? This is no longer a downtrend and you should stop looking for sells. Now, I did not say you should start looking for buys. I said stop looking for sells. So if you're selling, once price shifts to this market now, the chances of sales happening is what very, very low. It's very, very slim. So I should stop looking for sells. Do you guys understand? So whenever I have a shift in market structure in a downtrend, stop looking for sells. So now let's jump on our chart and then let's take a look at an example of a downtrend. One sec. So let's look at a downtrend example. Sorry. Okay, here we basically had a short downtrend. But if you look at this market, you see that price was basically from here we created this low, and this low broke below the last low. So we had a lower low. Price went back up, we created a lower high. We came back down, we broke below, and then we created a lower low. We went back up, and then we created a lower high. We came back down, and then we created a lower low. One thing I want you guys to take note of is that you can see that price is not just, we're not just looking at the movement of one candlesticks. So we're looking at what price is doing, what the flow of those candlesticks is, or what the flow of those candlesticks is basically doing in the market. Now, after this lower low, you see that price went back up and then created this high. Now, if you take note of this high, or if you observe this high actually broke above the previous lower high. So in this case, now the market started was shifting structure. And like I told you guys, whenever price shifts structure in a downtrend, stop looking for sells again. Now, if you observe, after that shift in market structure, price basically what started pushing up to the downside. It basically started doing an uptrend. Do you guys understand? So whenever I have a shift in market structure of a downtrend, whenever price breaks a lower high in a downtrend, stop looking for sells. Why? Because there's a potential that the market could start what? Going to the upside. Do you guys have any questions regarding this downtrend? A downtrend is a market where we're looking to sell. Do you understand? And whenever price shifts structure in a downtrend, please stop looking for buys. Sorry, stop looking for sells. And how you know that price has shifted structure in a downtrend is if the market breaks above the previous lower high. Now, the next trend we have is a ranging market. A ranging market. A ranging market. Now, a ranging market is basically a market where price is not creating new highs nor new lows. Price is just ranging in between a high and then a low. So on paper, we have something like this, bouncing up, down, up, down, up, down. Do you understand? This is what the textbook illustration is supposed to look like. Sorry. This is more or less the textbook illustration. But then, normals, the market is never going to be perfect, or it's never going to be picture perfect. So you'd have small structures in between. So you could have something like this. Overall, price is just bouncing in between a high and then a low. Do you understand? Something like this. Something like this. Yeah. So we have our high and then we have our low, whereby price is just bouncing in between. Now, the number one thing you need to understand about a downtrend is that, a ranging market is that this is a low probability market condition. But then if you still want to trade it, you can look to buy from the lows. Anytime price taps the low, you look to buy. Do you understand? Anytime price taps the low, you're looking to buy. And whenever price taps the high, you're looking towards sell. Because it's from there that price starts was pushing to the downside. Do you get? But then understand that it's a low probability market condition. That's it, that buys and sells. The chance of buys and sells, you catching those buys and sells in the middle, that's all this inside market structure. The chance of you catching them, if you don't really recognize that it's a ranging market, you lose, or in short, you lose your money. Do you understand? So it's a low probability market condition. But if you want to trade it, buy from the low, sell at the high. So now let's jump on our chart and then let's take a look at an example of a ranging market. Most markets were ranging in January. One sec. We're ranging in January. Yeah. So now if you look at this market, you see that from here, from when price created this low till down here, you see that price was just bouncing in between that low. And then if you look at the high is at the top here. Price was just bouncing in between that low and then that high. So somewhere like this, price was just bouncing in between. Do you understand? It was up until this point here that price exited. Do you get? So if you want to trade it, you can look to basically sell whenever price taps the top and then buy whenever price taps the low. Do you understand? That's basically it about ranging markets. So